Cool. So today we're going to walk through the Kudo Income Fund. I'm going to dive deep into fund performance, into fund structure, into underlying assets, all those things here too. So we'll go through the presentation for about 20 minutes or so, and then open it up here for Q&A. And we'll also do the recording here after too. Give me one sec. Okay, cool. So the Kudo Income Fund focuses all on small business working capital for small businesses, right? So all focused on business financing. We've got the typical disclaimer here, right? Again, read through this on your own time. High level, nothing is focused on, or, no past performance is indicative of future performance, right? All of those things. So take a few minutes to read through this as well. Highlighting the principal's experience here. So this is a really big component of it. So the sister company, Direct Funding Now for Kudo, has funded over $1 billion the last 10 plus years, 11 years to small businesses, right? And just in 2025 alone, that was over $250 million. And we'll kind of dive deep as to why this makes a difference for us. There's over 100,000 contacts in the database. All this historical data we have in terms of what companies make the most sense to fund. And we funded over 10,000 different businesses, some of them many, many times. And again, this is 10 years plus in space between myself, Gil on the investment side of the house, over $5 billion of transaction experience. So deep, deep ties in that space too. And here, looking at the team themselves, right? So Gil is the CEO. So his kind of previous background was focusing on the real estate investment space, which a lot of you listening actually come from that space too. And for him, he was the chief investment officer where they sourced and worked on over $4.5 billion of institutional real estate projects with very, very large single check writers, right? Very big type deals. Previously working at Citigroup, which is really important here too. And then Christian Ken. So Christian kind of leads all things operations and sales at Direct Funding Now. Direct Funding Now is the sister company. Both Christian and Ken own that company together. It is a brokerage focused on the same types of fundings we focus on in this portfolio today too, in this fund. And they've been around for 10 plus years. They've been the Inc. 5000 many, many times, right? Christian leads all things relates to sales, operations, right? The whole sales floor. They're 60 plus employees in the office in Irvine, California. And Ken leads all things relates to marketing and technology. So everything from driving the right leads, the right businesses, right? Running all things back office and operations there as well too. Then myself, I lead all things investor facing, chief investment officer here in terms of deal structuring, deal flow, and then working people like you on this call today too. And then here, what is emergent cash advance, right? This is the underlying asset that this fund invests into. So if you look here, right, this is a really, the big benefit here is that it's really quick financing. So for anyone who's worked with a bank, maybe an SBA loan, right, this process can be very, very difficult to go do and very time consuming. So if you need to get access to capital very quickly, right, effectively what we're doing is we are buying the future revenue of a company at a large discount. So we're basing all of this off of their historical revenue, right? No future growth built in. And in turn, we're taking back a multiple on the amount we finance them, which typically ranges between 1.2 and 1.4x over a period of between 6 and 12 months. All of our fundings in this portfolio so far have been in that range, with an average of 9.75 or so. And what we're doing is we're taking a certain percentage of their revenue, debited from their account, whether it be every day or every week, right? I believe about 30% of our portfolio right now is once a day, Monday through Friday, and about the other 70% or so is once a week. And again, these repayment periods are between 6 and 12 months in our portfolio today. There are some in the outskirts, but they're all fitting between 6 and 12 months right now, with an average of right below 10. And these are working capitals for growth capitals. They aren't like a traditional loan as well either. and the financing process, right? I think this here is the biggest differentiator about why this fund has been successful so far and likely will be going forward. So all of our deal flow historically has been sourced in-house from direct funding now, right? Kudo Capital and direct funding now are in the same office in Irvine, California, right? Their business right now, the last 2 months, for example, has brokered to third parties $25 to $30 million a month, right? And this allows, right? This allows for us to go take the highest quality of those deals and bring them in-house. So that's anywhere from right now about $2 million a month or so. We're taking the top, 15%, 10% of the deals they're bringing in-house, and the rest that aren't hitting our criteria are being brokered to third parties. So it's allowing us to get kind of the first right of refusal for all the deals they're doing in-house to go pick the best quality for the fund itself too. And then the underwriting component here too. So this goes back to the data around how much data we have from all these companies the last 10 plus years. So for us, this is a huge component of it, is that we know what criteria in businesses will typically allow for a funding to be a quality funding, right? In terms of risk profile, in terms of attributes we need to go see, everything from their credit score, time in business, overall revenue, use of funds, location, industry, right? All these data points that we have internally that we want to go see and go make an opinion on prior to, right, giving out capital. This goes through the whole automation, right? That first views it. Second, we have an in-house underwriting team too, where they're going to hand out underwritten for the deals that fit our kind of rough buy box. From there as well, we have a deal committee internally to go sign off on a deal too. So there's many processes and steps before someone actually gets funded. We can do it very quickly, but there are a very good series of steps and processes before it happens. Additionally, that we have the brokerage business, which works with 30 external funders. So third parties we work with. In turn, this allows us to go see their data, what industries they're working on, what areas they're pulling back on, structures, terms, et cetera, to be really competitive. It also gives insight as to what areas maybe that we shouldn't fund as much in, or what areas may have risk coming up. So third is a servicing component, right? All this is in-house, from customer service, in-house servicing. And this matters for a few reasons, right? One is we can go work with the customer, have a good relationship for renewals, right? Some of these people, businesses fund with us 2, 3, 4, 10 times over a period of a handful of years. So it allows us to go work with people we've worked with in the past. Over half of direct funding now's fundings are from previous businesses they've worked with in the past. So a huge benefit of working with groups multiple times. Additionally, we can go have really good visibility to if there are any issues come up. Is there seasonality? For example, right, in New York, in the Northeast, there's a huge snowstorm, right, a few weeks back. And we had, say, for example, a trucking business that was there that couldn't get their trucks out for a few days, right? And that cost them revenue for that week. We can go see that, work with them closely, restructure their agreement to give them some forgiveness for that week or two, to allow them, they're not going to default, they're going to work with us, right? To allow us to restructure that agreement to factor in things like seasonal or weather issues that impact them for a short period of time. And then again, that renewal process too, we have the relationship there. We can go work with them on renewal, and that is typically less risky than a net new customer. And why invest in MCA? This is a huge, huge, huge market. There are 33 million small businesses, and traditional lenders are either one, they won't take certain loans like this, or two, they are just work too slow. Like if anyone's done an SBA loan, I've done some myself, and these take 4 to 6 months sometimes. And businesses may need capital very quickly. For example, right, take Florida with a hurricane that happened, 2 years back. People had, say you're a roofing company and you have to go get new crews, new equipment for all these jobs you just won. Say you're doing one roof, 3 roofs a week, and I have to go do 20 the next 2 weeks, right? Like you need massive amounts of labor and equipment, right? So for them, waiting for 6 months for a loan just won't work out that way, right? So for them, the speed of capital matters a ton here. And for us, right, this is really appealing because we can go get, in turn, better rates internally than a bank would get, or private financing would get too. So this is really helpful for us, and it's really great for the business too in terms of speed of capital. These are paid back in a daily or weekly amount, directly debited from the business's accounts, which is super helpful. And then, kind of looking at this, right, these are also fully amortizing. So for example, in a traditional loan where it's interest only, say it's 12%. You're going to get 1% per month as a lender. Here, we're getting back all of our principal and interest, right, every single day or week, broken out in even payments. So it's very helpful in that sense too. Again, diversification. Right now in our portfolio, we have close to 70 fundings, right, just in the last few months alone. And these are across 25 plus industries, 25 plus states. By the end of the year, which would be hundreds of fundings across the portfolio, diversified across many industries, many areas, right? Different sizes, structures, terms, all of those things. So by placing capital in one place, you're getting a massive amount of diversification as well too. And again, the competitive advantage here is the sister company, direct funding now, right? This allows us to have clean deal flow, right? All data, full control over it, right? All of those things that allow us to truly have our hands in every component of this process and mitigate risk in each area, right? Taking all the data, the team, right? So we have a lot of roots there as well too, which is super helpful for us. And then industries, right? We are all across the board. Here are just some of the industries that we're in, a lot of trades, HVAC companies, roofing in that space too, landscaping, logistics, transportation, all different kinds of construction companies, auto repair shops, manufacturing companies, retail stores, healthcare services. One thing we just did recently was we funded a group who had a big portfolio of Denny's restaurants, right? So things that are, name brand quality companies, which is really important here too. And the profiles of these companies too, like I want to give you a few examples of what this can look like, right? So take Eric, had a landscape company for 15 years in California. They do, $150 a month basically in revenue. And for them, they need $75,000 for inventory because busy season is coming up. And for them, the SBA loan, again, to highlight this, is that it takes a long time. So we will often lend to companies that are in the process of an SBA loan and need a certain amount of capital for that gap period, right? So they can go work through this. Again, similar with Sam in Mississippi on HVAC company, they're doing $300,000 plus a month in revenue. And for them, right, they've worked with us 9 times already. And, they need $30,000 for a project, right? They paid off in 4 months. And for them, like they just needed, capital to go complete a large project that had a big capital outlay. Jeff, beef jerky business, right? They've been around for a while in Montana. They do, almost $350 a month in revenue, $400,000 a month. And for them, they needed $100,000 to complete a big purchase order, right? Due to buying in bulk from a new distributor. And what you see at times, these companies have tough cash flow cycles or poor cash flow management, and we can go help solve that gap for them pretty quickly. Here's a quick look on our stats from this past January. So in this fund alone, we have funded, this is as of January 31st, we're actually funded a few deals this week so far, $5.7 million in total funding volume, almost $2 million in January alone. We're across 62 businesses. I think we're more than that now as well. 19 businesses were funded in January. Over $80,000 in distributions were paid out. This makes the entire return that we were owed. And the portfolio retrieval rate, this is the average of each of the businesses. So it's not weighted. Weighted is actually much lower. And the retrieval rate, if you look at it, that number means that if a business is doing $1 of revenue, we're taking back on average 9 cents of that dollar every single time period that it's in. So basically 9% loan to revenue ratio, which is very, very low. If you actually weight this, it's closer to 5 or 6% because we have some very large companies here too that have taken bigger checks. They're actually much smaller as it relates to retrieval rate too. We felt this average was a more fitting number to share. Now the fun part. So this is how we structure the investor returns. So a big thing to note here too is that us as managers, right? Myself, Gil, Ken, Christian, we don't make a single dollar until these numbers are fully achieved to investors. So we have 3 structures of returns, all based on check size. So 10% preferred returns at 100K to 250, 252 million is 12%, and 1 million plus is 16%. And on that, your capital is locked up for 1 year from initial investment. After that 1 year is over, you can keep your capital in the fund as long as you want to, right? But you can request your capital back anytime, and our goal is returned to you within 90 days. You also have the option of compounding as well, right? So you have the option of deferring your distributions, and they can go compound every single month as if we gave it to you, and you give it right back in terms of distributions here too. So here's a quick chart showing the power of compound interest, right? The 8th wonder of the world, walking through each one of those scenarios in terms of what that return profile would look like. Here's also a quick example of what this looks like too for sample returns on the each structure investment with their minimum check size in there as well. When looking at the overall yield on a per month basis at the full return profile, to date, we have not missed a full return since inception. So again, here's my contact info. Thank you all again for joining and watching. And I will open it up here to any questions from the audience. So feel free just to drop it in the chat or raise your hand here as well. Okay, so first question here, is there any flexibility in that recall being closer to 60 days? So our goal is to get it back to you as quickly as possible. In the fund itself, I think a big thing to think about too is that we have about 14 to 15% liquidity in the fund every month. So if we put out $1 today, we'll likely have about 14, 15 cents back next month. So we expect to have meaningful liquidity, and our goal is to return the capital as soon as possible to an investor. So while we can't commit to that, we expect it to be as quickly as possible for that. Did that answer your question? Cool. So what is your default rate for payments? So this is a big thing too that I actually did not cover. In our model, we can handle about 25% of the capital that we put out gets defaulted on, and we can still pay the full return to investors. Historically, we have actually had no defaults in our portfolio yet, but we've had a few restructures. We think we'll land between 6 and 8% across the portfolio, leaving sizable buffer room to get that 25% number before actually any payments are impacted to investors. Okay, just cover that too. What percent of businesses must default before you cannot meet the target returns? About 25% of total capital. So weighting it on like a per capital basis versus a business basis. And then we see, what is your screening criteria for businesses? So I can share some data around this too. Our average business across our portfolio through the end of January, they've been in business for about 11 years, average credit score of about 682, average revenue of about 2.9 million. So looking at key things such as that, right, in terms of credit profile, time in business, type of business too, right? Also a big thing you look at too is like how often are they getting paid? So for example, a good example of a company we would not fund is a development company, right? So you're building houses where that can be a great business, but one, it's risky, but more importantly too is that they get paid like once a month, once every 2 months. So we want a company that has payments very frequently, right? So getting paid multiple times a day, multiple times a week, so we can go draw directly from their ACH in that sense too. What are some of the biggest risks with this model as an investor I must think of? So I think the biggest risk to a portfolio like this is like a COVID 2.0, in which we see all these businesses just shut down. I think how we counteract that is that we're across, by the time that this year's over, probably 45 plus states, probably 50 plus industries at that point too. And if you kind of think about it, right, by getting 14, 50% back of our capital every single month, we can go reallocate the whole portfolio in a period of 6 or 7 months. So if anyone here is invested in, say, apartment complexes, right, you've got one big asset that is very illiquid. On our end, right, we're across hundreds of deals by the end of this year, right now about 70, where we can go redeploy the portfolio very quickly for areas that are getting impacted, for industries that are getting impacted, for like whatever it may be. We can go take the third-party data that we have and go start repurposing capital so it comes back in. I'd also highlight too, there is no risk of a capital call in a deal like this, as we would never have to go put more capital into a given project. We just stop funding if we get wherever short on money. So there really is no risk of a capital call here either. Cool. All really good questions so far too. So thank you for that. Okay, how are you guys getting A paper clients? So I'd say most of our clients are an A and B type paper overall. Um, direct funding now probably has 60 to 70 employees, right, full time on the brokerage side. So this I kind of use the example of, say you're a property manager in real estate, and you've managed deals your the last 10 years, and all the income sheets of the business, all the context there, the marketing strategy behind it, and now you want to start buying your own deals, right? So I'd say all this is our marketing to, we put up, they spend a lot of money on marketing every single month on the brokerage side to attract a certain kind of clients that we want to go bring in house, right? So we want the highest quality paper on our end, because think about the model too is that we don't get paid unless we hit that full hurdle to investors. So we take all the risk here right with you, right? There's no fees, there's no compensation to it. All of it's focused on the highest quality deals we can go possibly bring in. The brokerage itself allows for that. Okay, what is the max loan amount per business? I say it really depends. So if you look at our portfolio right now, I'd say 3/4 of our portfolio is under 10%. So how we figure that out is what is their total revenue and what's the revenue in that time period. So if it's a 9-month funding, we take 3/4 of the revenue and we're below 10% of that. So 3/4 of them are for that reason. We have some that are about 20 in the portfolio as well in terms of revenue, and that's for very specific type reasons. So if we go higher, at the very specific type criteria that they hit for us allowing kind of that higher allocation towards it. But I'd say weighted right now we're in that 5-6% range per business. So on the note, if there's a black swan event and more investors than 14-15% ask for liquidity by investors, do you place a cap on it? So all of our return of capital is based on capital being there to return. So between the that would be more so on like a first come first served basis. There's a black swan event, the based on kind of buy requests that they handle as they come out. So for example, if we had $1 million that was requested and we have $500,000 and it's all 10 to 100K investors, they would get broken out one by one by one. So do you charge the asset management fees at all, or any fee charge for maintenance of the fund before the 10 to 60%? The only thing that is there are direct expenses, right? In terms of things like accounting, legal, some technology, right? Like a CRM and things like that. But besides that, the management team takes zero compensation for it. The only big OpEx we have is underwriters, right? Underwriters are billed to the fund as we need them to go make offers on deals themselves. So nothing in terms of an actual fee, purely expenses that are directly passed through. But in terms of compensation for any for the partners on the deal, no. Cool. These are all really good questions. Well, any other questions here? All really good questions to say too, which is awesome. So question, right? Sorry, I missed the fund compensation structure. What was it again? In terms of investors, right, we have 3 share classes that are 10, 12, and 16% preferred returns. So in that structure, what that means is that the first 10, 12, or 16% gets paid to investors prior to the manager compensation kicking in. Right. So basically it's capped at that number for investors, right? The 10 to 16%, but it's paid entirely first in structure as well with zero fees. So we view it as very, very de-risked in that sense too. Okay, Sandia, do you have a percent allocation by industry if it gets lopsided, like 10 roofers in a row? Not really, right? And kind of looking at it, we don't really put a cap by industry. Right now, we're across 25 or 30 industries right now. So there really wouldn't be a scenario in which we have way too much weighted in one specific area. If that became the case, like we'd start revisiting it, but we don't have like a formal cap or kind of allocation to a given asset class because we can go fund, say, for example, 10 roofers. Those roofers may be across 10 different states or different geographies, different sizes, different structures too. So, all of those things. So we don't have a specific cap on a given asset class. We more so kind of look at the portfolio as a whole. I say we are really looking at as well like weighting of each amount by funding. So, for example, our average funding amount is like $92,000 right now. we think we'll be in that 90 to 120K range between low end right now of call it 25K and high end of about 2 to 250. So question, do you get losses for taxes similar to real estate or is it purely a cash flow play? So I would look at this as a pure cash flow play. On my end, there is not great tax treatment here, right? I'm looking at this as all of it short term. Um, so yeah, it's definitely very dissimilar to real estate in terms of how it's treated tax wise. I would say this is much more of a cash flow type investment. Okay, question here. Is the sister company the only one providing the businesses, or do you have other brokers? So right now, it is exclusively the sister company. In the future, as we scale, we may look at bringing in third-party brokers and ISO shops to have more consistent deal flow. We still have a lot of runway in terms of the amount of capital we have versus the deal flow they have from the sister company. The sister company is also growing pretty significantly too. So I think we'll have some good runway with that. But that being said, we're always evaluating different ISO shops and brokers to potentially bring in more deal flow to if and when that's needed. So question here, how long investors stayed in your fund before asking for a full return of investment on average? So this fund's been open for 4.5 months so far. Prior to that, this was all kind of our personal money, kind of working a lot of the kinks between myself, Ken, Gil, and Christian. So to answer your question, we haven't had redemptions because we're too soon in the fund itself. And that's my better question here in 8, 12 months down the road. So right now it's been zero, but just because of how long the term has been so far. Where does most of your deal flow come from? Direct ISO shops, relationships, brokers, in-house marketing. So all of it is from in-house marketing, right? Between buying lists, cold calling, right? All that relates to the in-house data we have internally. So all of it right now is in-house. We expect in the future that if we keep growing how we think we will, we're evaluating how to go bring in third-party ISO shops as well. And aggressively staffing up our underwriting team as well to be able to go underwrite more and more volume of deals as well too. We think we have a lot of capacity right now just with direct funding now. For example, they're funding about $25, $30 million a month. Our fund last month funded $2 million of that. We still have a lot of runway internally before we can go creep up. We think what we'll see with direct funding, about 20 to 30% of their volume actually makes sense to go keep in-house. So we're working way to go keep more of that volume as well internally. Cool. More and more great questions. I like it. So, okay, question here. An earlier version of the fund you ran with your friends and family. How did that do return profile, defaults, liquidity requests? How long did that fund run? It was really just us four and like one family member with that. And each deal was kind of on like a case by case basis. We probably funded, I can give you the exact data for that as well too, in terms of the data around that. But we were well within the 6 to 8% range in terms of default here as well too, on like a per capital basis. In terms of liquidity requests, it was just our money, so we didn't really have any liquidity requests there as well. This was all intended to go build out to go launch this fund hereafter. And for context too, the principals have well over $1 million of our own money into this fund as well in terms of our own cash in the fund. So we're right there with you alongside. So question here, what is the target fund size? This is an evergreen fund in structure. Right now, we're about 7 and change million. We think we'll end this year between 25 and 50 and are kind of staffing up accordingly to go support that kind of based on projections each month. So so evergreen fund will keep growing until we hit some restrictions around that in terms of sizing and scope. Question. So your firm only provides private credit. Does the firm work in equity, real estate, non-levered? The fund itself is entirely non-levered. All of the money we are funding is directly from the fund itself. We're taking on no leverage in this fund, but we only focus on deals in this type of structure in the MCA space right now. Real estate deals do not work for the return profile we need to go hit. Yeah, no equity type deals. All this is creative financing for small businesses right now. So question here is this a 506B or 506C investment to accept non-accredited investors? This is a 506C fund. So we only work with accredited investors. Well, any other questions from folks here? Some awesome questions today too. So thank you. Do you have a 2026 goal for funding? Um, I think we'll land towards 25 to 50. I think we have a good chance at landing on the higher end of that range with how things have been going. But we'll always keep evaluating to make sure we can go efficiently deploy capital. We'll never take on money that we don't need. If you're going to look at incentive-wise too, it makes sense for us as managers to do so. And our first goal is obviously preserving and maintaining investor capital. So we never go take on unnecessary capital. So we're always evaluating too if we can go keep on taking more capital and what that looks like. But I think we'll end this year closer to 50 than 25. Cool. Anyone else have any final questions here too? Happy to stay on for a while. Would you ever offer more than 16% for larger checks than 1 million? So it's a conversation we have had internally. I think we need to go see how the next, 6, 12 months goes before we make that call. Right now, we have not had an issue with capital coming in. So I think it'll really depend on our ability to go deploy capital consistently and efficiently. And if it makes sense to go potentially offer larger breaks for, say, 5, 10 million dollar allocations at once. Cool. And I will drop my info in the chat here too. So, question, is the sales team growing? Yes, they are always hiring, but exclusively in Irvine, California, in the main corporate office. So, if you're interested in doing that, Ken Manisi is the contact there. I have make an introduction for you as well. If you're in Irvine or looking to go move to Irvine, it's definitely a great place to go work. So, question here, how certain distributions do we have to after send the money? It's a great question. So, we start our preferred returns every first of the month. So, if you would invest before March 1st, March will be your first month in the fund, your first distribution would then be on or before April 15th. So, we actually just triggered a distribution about an hour ago for people who were in the fund for all of January. So they'll get their distribution before February 15th for investors that were in the fund prior to January 1st. So there's no waiting period. It is just the first of the month preferred returns start accruing and then paying out the following month, therefore after before the 15th. Some private credit, private debt funds make you wait till capital is placed, right? We take that on ourselves and we have it start every first of the month. Question, so where does your firm typically invest? What's typical check size, industry? We covered a lot of it beforehand too, but as a quick high level, our average check size about $90,000, $92,000 right now across the fund itself. And industries, we've got a huge range. Service companies, trades companies, HVAC, manufacturing, roofing, auto repair shops, trucking, retail, service companies. So a big range across the board. We're in about 25 plus industries right now. These are all great questions. So making it a lot more fun today. Cool. We'll give everyone another minute or two. Any more questions pop up, but I'm always available via email or phone as well too. If you want to go discuss anything further here, or have kind of specific one-off questions too, so always happy to go dive deeper into that as well. So we'll give it another minute and we'll hop off here. Cool. Everyone, well, hey, thanks for making time middle of the day. Definitely appreciate it. And any other questions or anything that pops up, feel free to ping me directly. You also have my email and contact info as well. We'll send out a recap to everyone here too. But yeah, thanks again for attending, and we'll get the recording here out shortly. So thanks, everyone.